Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time.
All opinions expressed by the host and the podcast guests are solely their own opinions. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show this week is Jake Barfield, the founder of Asheville Capital Management, a long-only investment firm that seeks to invest in world-class companies before they are broadly recognized as such. Jake is also the host of his own podcast, Quality Investing. In this informative episode, we covered the founding inspiration for Asheville, the type of companies that Jake is not going to invest in, position sizing and concentration, what Jake finds so interesting about a company called InPost, and why he decided to start his own podcast. And without any further ado, here's my conversation with Jake Barfield of Asheville Capital Management. Jake, I'd love to start off with what made you decide to start Asheville Capital Management.
Yeah, I think there was always a desire to go out on my own, to start a business of my own of some sort. I think more than anything, it was just this desire for personal autonomy and control to sort of chart my own path. In terms of starting it when I did, I had a handful of friends that were very supportive. Most importantly, my wife, who was supportive of me. She encouraged me down this path. She has been and always will be my number one fan. And that gave me a lot of confidence to actually go out on my own. In addition to a few friends and mentors who were supportive of me and to the point to where they were willing to invest on day one. And so that alleviated a lot of concerns, not starting with $0 of AUM or a few thousand or something like that. So having an initial floor that I could go out on just helped to de-risk it a lot in my mind. It helped me to determine that I had a particularly long runway. When I launched, I said, if no performance fees are generated, if AUM doesn't scale, and if my wife's salary, because she works, if my wife's salary doesn't increase, we have 3 years of runway. And fortunately, over the last 3 years, all three of those things have paid off. There's been a little bit of a performance fee. AUM has increased. Salary of their own work has increased. So runway has been extended almost indefinitely at this point, despite Asheville Capital still being relatively small. There was a reasonable degree of confidence for me to go out and do it on my own. And then I think lastly, there's a quality of life component to think about this. We love Asheville. My wife grew up here. She went to high school right down the road, North Buncombe High School. And all of our family is here. We have young kids. And so when we were living here during COVID, I was working remotely for my previous employer. We initially moved here only thinking it was going to be short term. And eventually I'd have to leave. I'd have to go back to Austin, or I'd have to take a job in New York or something like that. But then when we decided to go for it, the real logic behind it was we want to be here forever. We want to be here in Asheville. We want our kids to grow up knowing their cousins, knowing their aunts and uncles and their grandparents and things like that down the road. That was just really important to us. And so we started with the ultimate goal in mind of 20 years from now, we want to be in Asheville. And over the next 20 years, we want to have spent that time in Asheville. We don't just want to be moving here 20 years from now. We want to have spent our time in Asheville. And so with that goal in mind, we started thinking about what needs to happen in order for that to really be durable, for that vision to really be durable and long term. And it became pretty obvious. I need to start my own firm. So in addition to the desire for autonomy, in addition to friends and family being supportive of this, there was really just a desire to be here in Western North Carolina. I think it's one of the most beautiful places in the world. Quality of life is really high. And yeah, so the confluence of those three factors, I guess, was the real reason behind it.
And when people ask you to describe your strategy, how do you explain it?
Yeah, I try to describe it very simply. We invest in what I refer to as world-class businesses before they are broadly appreciated as such. And so there's two real components to that. The world-class businesses is first and foremost, companies have to be of an extremely high quality And you can determine what an extremely high quality is by looking at hundreds of businesses over years, thousands of business over multiple years. And as you continue to look at businesses, you continue to get a gauge for what a really high quality business is. And so as I define it, is companies with durable competitive advantages, with aligned management teams, most usually founder owner operators that are highly aligned with shareholders, that have the ability to grow capital efficiently, which I'm sure we'll talk about soon enough. And so world-class businesses, but before they're broadly appreciated as such. So that implies that the price that I pay is really important for these high quality businesses. I'm not just going to go out and buy Apple and Google and Microsoft and Amazon because they're amazing businesses. The way I define it is before they're broadly appreciated as such. So there's an inherent valuation that matters, but also I want to own them at early stages in their growth cycles. So I want to own them if I think that they can compound at really high rates of return, compound intrinsic value per share at really high rates of return for an extended period of time, for a decade or longer. And so those two components really drive the strategy behind Asheville Capital and sets a really high bar for inclusion to the portfolio, which is why we're highly concentrated.
And I know you don't have a lot of limitations around geographies and market caps of companies you invest in, but are there certain places or types of companies, maybe in terms of industries, that you gravitate towards?
Yeah, you're right. So there's not a lot of restrictions on where we can invest. We're geography agnostic, we're size agnostic, we're industry agnostic. And so the universe is really wide open to us. With that being said, I want to own great businesses. I don't invest in commoditized businesses. I don't invest in highly cyclical businesses. I don't invest in countries that don't follow rule of law. I don't want to wake up one day and find out that my company's assets have been seized and it's now a government-owned company or something like that. That narrows it down a little bit. But, I really just want to invest in areas where I can find business models that are understandable, that are going to grow shareholder value at high rate of return with a reasonable degree of confidence.
And is this founding philosophical benchmark that you're starting with, that is the reason why I'm able to buy, find these businesses before someone else, is they're in markets that no one else looks at, or they're too small for other people? Is there some kind of inefficiency that you're trying to capture? Because everyone wants to buy a world-class business at a world-class price, but that's easier said than done. So I'm just curious if there's some philosophical bent that's pushing you in certain areas or directions to find these businesses.
Yeah, I do think there's a number of inefficiencies that exist today. And the reason why I own entirely international companies right now is because that's where the opportunities exist. I'm finding very attractive opportunities in Japan where there's significant price dislocations. But I think that the more overarching theme, if you were to sort of back up and see the forest here, I think in international markets in particular, i.e., countries outside the United States, there's a handful of factors that are affecting and creating these dislocations in the first place. There's a lack of passive investing in many of these opportunities. And so you can actually invest in larger cap companies that don't have significant index inclusion, unlike in the United States. There's also a lack of private capital chasing some of these opportunities. And so particularly in Japan, but also elsewhere, you're able to invest in companies at earlier stages of their growth cycle. So because of a lack of private equity available or private debt even available, companies are incentivized to IPO at earlier stages of their growth cycle. Whereas in the United States, they might stay private for another 5, 7, 10 years, something like that. And so you're able to invest in them and sort of ride the growth curve at an earlier stage of the cycle. And so that creates some attractive opportunities. But in addition to that, because of a lack of private equity available and because of a lack of talent available, frankly, in some of these countries, companies are able to replicate business models that have proven to be successful in the United States internationally with a genuine lack of competition. And so I've seen this in a number of different countries, companies that take proven business models in the United States, they localize it to their individual country, and they can grow at really surprisingly large levels of scale without really any new competitors entering the space. Now, eventually competitors do enter the space, but by then they've had a longer period of time to build out their competitive advantages, to widen the moat around their business. What that fundamentally results in is faster revenue growth rates, faster payback rates, most importantly, faster payback rates on customer acquisition or, new units deployments, of assets that have higher returns on incremental capital. And so the combination of those factors really results in attractive opportunities internationally. And so, I'm not opposed to owning US-based businesses. Actually, I would love to have more US exposure, but I'm finding the opportunities to be most attractive internationally, which is where we're invested today.
Sounds like you're willing to invest in companies even if they're not yet profitable. What role do those play in the portfolio?
Yeah, so I am willing to own unprofitable businesses today. I think it's important to point out that of our 9 holdings today, all 9 of them are profitable. With that being said, I think they're at very early stages in their earnings inflection. So some of them have only been profitable for a couple of years. Some of them have become profitable during my ownership period. But in almost all cases, I think that they are at early stages of an inflection curve higher. They're doing 10% profit margins today, and I think that 30% or 40% is reasonable in the future or something like that. So they tend to be inflecting higher. But specifically in regard to owning unprofitable businesses, I'm willing to own them if there is a logical path towards profitability in the future, and if there is a logical reason for why they are unprofitable today. So oftentimes that tends to be because the reinvestment opportunity is really high in front of them. And so I'm not opposed to a company investing more than 100% of their operating cash flows back into the business in the form of CapEx or marketing or sometimes even acquisitions, if it means that they can grow at a faster rate while generating a high enough return on that capital. And that's the crucial thing is there has to be a high enough return on incremental capital to justify the allocation of that capital. And whether they're profitable or unprofitable kind of doesn't matter if the path is logical. Then additionally, you can find more pockets of dislocation in unprofitable companies because they don't screen well. It's not easy to just slap a PE multiple on this and say it should be trading at this. You have to do a little bit more diving in. You have to do a little bit more research to determine, what the individual unit economics are and what this looks like 2 years, 3 years, 5 years into the future. I'm not really willing to own a company that's unprofitable and will be unprofitable 5 years from now. But, I definitely want them to achieve profitability within a relatively short period of time.
In that response, you alluded to capital efficiency, which I know is something that we've already mentioned and is very important to you. Talk to me a little bit about, what capital efficiency looks like to you. And, sounds like return on incremental capital is the metric, but maybe talk a little bit about how you're typically measuring that and assessing that over time.
Yeah, I think that there's a couple of really good pieces by a person named John Huber on this subject that has been influential to me over the years. And, return on incremental capital, actually, it wasn't written by John Huber. It was written by a guy named Connor Leonard on John Huber's blog, where he writes about return on incremental capital and why it's really important. And I would point all of your listeners to that piece if they haven't read it yet. I mean, capital efficiency is the most important thing, in my opinion, in terms of looking at businesses. I want businesses that can grow intrinsic value per share at high rates of return. And that's a product of the reinvestment rate, what percentage of cash flows are being reinvested back into the business and at what rate of return. And so, I tend to own companies that are generating low returns on capital today because they're at earlier stages of their inflection curve, that are generating much, much higher returns on incremental capital. And so therefore, over time, you should see return on total capital improve. Another paper I would point you to is written by Michael Mauboussin, which is ROIC and the investment process. And there's a table in there that I've written about numerous times that shows companies that generate truly exceptional returns. He looks at over 3-year time periods, but I've also looked at this over 5 and 10-year time periods. Companies that generate improving returns on capital, even if they start in the bottom quintile, the worst 20% of the investable universe, even if they improve just from the worst 20% to the second worst 20%, they end up generating attractive returns and companies that continue to improve. And so I want to own businesses that are early in their growth cycles, that are generating low returns on historical invested capital, but there's some sort of qualitative component. There's some strong competitive advantages in place that are allowing them to deploy incremental capital at ever increasing rates of return on total capital. And I think that's a winning formula for producing attractive returns over multi-year periods.
You talked already a little bit about what you are looking for. I think as an investor, you also have to know exactly what you're not looking for or what you're trying to avoid. In your launch letter, you wrote down what you call a list of nots, like things that you're not going to do. Why was that an important step for you?
Yeah, so I found that oftentimes it's easiest to describe what it is that you're trying to do well, what the one thing is that you're trying to do really well by describing what it is that you don't do. And so that's why I wrote that. It's called the Asheville Capital List of Knots. It's in my introductory letter that everybody can find on my website. And in that I write out a list of things that I don't do, because I think it helps them to get a sense for what it is that I'm really trying to do here, which is, again, owning these world-class businesses before they're broadly appreciated as such. And I guess additionally, I would say that while I don't have many restrictions on the areas that I invest in, the geographies, the industries, and the market cap sizes that I invest in, I think it's important that I put some guardrails in place in terms of the process that I apply. Because my big fear is that 5 years, 10 years from now, 15, 20 years from now, there is a significant style drift. I think that's something that every portfolio manager should be concerned about. And I don't want to drift too far from that. And so to the extent that I can put some guardrails in place in terms of my process and the way I think about things, to that extent, I think it will help me to continue to narrow my process and my system for looking at businesses and continuing to refine my sort of checklist that I look at.
It would be fun and insightful to go through a few of these to help people better understand your philosophy and approach, starting with your aversion to owning highly levered businesses. Tell me about why that was in there.
Yeah, so I guess I should qualify that a little bit. So I am willing to own companies that do have debt on their balance sheet. So, debt is oftentimes a cheaper form of capital than equity. And I'm happy with companies taking on debt if there are very durable revenue streams and a rational logic for doing so. If the debt will allow them to deploy larger capital than what their current cash flows are producing, what their current earnings are producing, then I think that makes sense to a certain extent. But overly indebted is obviously the two key words there. Is I don't want my right to those cash flows to continue to be subordinated below debt holders for extended periods of time. And so, while I will sometimes own companies with, debt on their balance sheet, I want there to be a logical and clear path, preferably historical data to prove that they are deleveraging and likely will continue to do so. But then additionally is the trouble you can run into with debt is your margin of safety in investing in an equity can be completely blown out of the water if a company is overly indebted. And so I can't honestly say to my investors that there's a high margin of safety if there's a significant risk of bankruptcy for one of my businesses. And so that's really important to me, is investing in companies with asymmetric returns, and a key part of that asymmetry is having a low floor for your investments. And so I can't say that there's a low floor for my investments if there's a probable bankruptcy, and so I think that's the logic behind that list of knots.
Moving on, you make a point that you don't arbitrarily determine position sizes. So how do you go about figuring out what percentage a single position should occupy?
Yeah, that's a really difficult thing to do. And I've heard a lot of people articulate, especially concentrated managers, who will say, yeah, position sizing is not really something I'm good at. And so I'll just slap a 10% on it, an average weight position, 10 holdings, 10% is basically what I'll do. Or they might initiate a starter position at 5% or 3% and try to scale it up over time. I definitely think about that to a certain extent. And I do try to initiate smaller positions and scale it up as I build trust in them over time. But I try to quantify some of these subjective measurements as much as possible. And so when you assess a company's sort of durability of revenues and earnings over multi-year periods, there is some subjective measurements that sort of go into that, and also their ability to grow. And so, I will think about these businesses, and it's really difficult to slap a number on, what happens in the event of tariffs or a global economic recession or high interest rates or inflation or, whatever macroeconomic event you might think about. And so I try to think about these things qualitatively and then to quantify it to the maximal extent possible, really with the goal of having, again, an asymmetric return profile. So I want my businesses, no matter what happens in the future, I want to have a high degree of confidence that they can continue to compound intrinsic value per share at high rates of return, and for there to be a low probability of me being wrong, basically. And so to that extent, I try to weight my portfolio based on an expected return basis going forward with an upside downside scenario, a probability of upside, a probability of downside, a magnitude of upside, and a magnitude of downside. And so thinking about those four factors is really important for trying to determine position sizes. And sometimes that means that I have a higher weighted position in a company that might have a tighter range of expectations than a company that might have a higher upside if the probability of downside or the margin of safety isn't necessarily there.
Within that, how have you approached the topic of the right number of total stocks for you to own?
Yeah. So my mandate, what I tell investors is that I'll own anywhere between 5 to 15 companies. And for the majority of the year this year, we've owned 8 positions. And so we're a little bit more concentrated. We're on the little bit more concentrated side of that. My sweet spot is really 8 to 12, I think. So with a happy place of 10. And I think anytime you get beyond 15, doing this type of research, trying to do deep dive fundamental analysis to really understand these companies like the back of your hand. When you get beyond 15, that just gets to be really difficult. If we ever own close to 15, that'll probably be because a couple of companies I would consider as one position, basically. So it would be a basket trade of sorts in a certain theme where I say, these are really interesting businesses, riding a tailwind, doing something that I think is really interesting. And I don't really know how it's going to play out or something like that. Or maybe it's across different geographies, investing in the same theme, something like that. And so if I ever get to 15, it'll probably be because there's 2 or 3 or 4 companies that I would consider a basket trade and really one position. And if I'm more on the more concentrated side of things, it's probably just because I'm not finding very many attractive opportunities. On that note, I find that in periods of drawdowns, I actually tend to get more concentrated because the expected returns fluctuate over time. And sometimes I will exit a position or trim a position, even though I try not to tinker with it too much over time. But I try to re-underwrite all these things every day. Every day is a decision to buy, sell, or hold a company. When markets tend to draw down, the beta of everything pretty much aligns with 1. And so in severe market drawdowns, like what we saw in April, although I wouldn't even call that very severe, Buffett definitely wouldn't. In drawdowns, like what we saw in April, I think it causes you to reevaluate some of these things, and some companies might draw down significantly more. And it causes you to, it's a great opportunity to sort of refresh your thinking on things. And if the expected returns fluctuate, and I can say definitively, yes, what I thought was a wide range of outcomes is actually now a pretty narrow range of outcomes because they're unaffected by this, or because they are affected, inversely, it could be the opposite direction. Then there are usually pretty significant opportunities. And so sometimes I will get more concentrated in these periods. But yeah, I mean, it's all relative to sort of what the available opportunity set is.
Another one of the knots that stood out to me was that you don't want to be over-reliant on DCFs. Talk to me about why that is and how you typically approach valuation.
Yeah, I think discounted cash flow models, I mean, they're great, but they can be a crutch for critical thinking if somebody becomes overly reliant on them. And so I do build out DCF models for all of my businesses, but in order to build out a proper DCF, there is a lot of assumptions that go into building these things out. And if you're wrong on any one of these assumptions, particularly, your discount rate that you might use, it can affect your end value very, very significantly. And people can get an overconfidence from relying too much on these DCFs. And so, yes, I build out DCFs for my companies, although I don't really care too much about like what the price target is that it spits out at the end. I really just want to make sure that I understand the dynamics of the businesses, especially for businesses that are investing in asset intensive industries. I really want to understand how the increase in CapEx flows through the balance sheet, flows through the working capital, and how that affects the 3 statements basically. And so that's really important to me, to making sure that I fully understand and building out these in a sort of proper way. I'll find that there's a lot of things that I thought I knew about the business that I didn't actually know about the business. And so it's great for helping me to formulate new questions to then take back to the management teams to then ask them. But, I think, again, it can become a crutch for critical thinking. And so I try to think about valuation from a couple different angles. DCFs are definitely a piece of it, although I'd say it's becoming less and less of a piece that actually affects my thoughts around the valuations of the businesses. And the other two areas that I actually tend to rely on more and more is the price implied expectations. So there's a really great book, again, by Michael Mauboussin, called Expectations Investing, which sort of flips the DCF on its head. It allows you to invert it. Instead of starting with the financial model, you start with the current price of the business. And it causes you to think, okay, so if this is the price of the business, what is inherently implied in the growth of revenue, the growth of earnings, things like that? And what's your payback rate on that? And so it helps you to really determine what the market is saying it expects this business to do. And when my expectations differ significantly from what the market implied expectations are, that's usually a pretty attractive opportunity. So the other way I like to think about businesses is I'll again reference John Huber. He has written about this thing called a 3 engines framework that I have found to be very, very helpful. And effectively, he looks at, or the way he articulates it is your total shareholder return, i.e. the return of your stock price over a period of time, is a product of 3 factors. So there's earnings growth, there is the change in multiple, and there's the change in the shares outstanding. So you could simplify that down further to EPS growth than multiple growth. I prefer to think of it as the 3, because earnings can grow, but then there's also a share buyback element at hand there. And so if you multiply these 3 factors, you should get your rate of return, basically. And I like to think about businesses that can grow earnings particularly, but also obviously if I buy it at a low multiple and there's a buyback going on, you can sort of get all 3 engines working in your favor. You sort of have 3 tailwinds sort of working in your favor that are really beneficial and can result in high rates of return for extended periods of time.
You mentioned talking to management as part of your process, especially when you don't understand aspects of the business. You state in your launch letter that you explicitly don't want to be an activist investor. Given that, what is your approach to engaging with management?
Yeah, so I think there's multiple ways to sort of generate attractive returns for your clients. There are many successful activists. That's just not what I do. I do engage with management teams to the extent they will allow me to, but my preference is not really to invest in turnarounds. It doesn't fit my criteria of world-class businesses. I think turnarounds can turn into world-class businesses and those become really attractive in the future, but I try not to invest in them in the turnaround period because, frankly, there's just an element of mismanagement going on that I'll just avoid if I can. And so, yes, I will engage with management teams, like I said, to the extent they will allow me to. And oftentimes that just comes with building trust with management teams over time. And I don't think that I am qualified to tell a management team how best to operate their business, particularly in some of these international countries. The way I think I can add value to management teams is more on the fringe. I find that it is rare to invest in a management team that is top tier operationally and also top tier from a capital allocation perspective. And to the extent that I can help them to think more critically about capital allocation, I think that's where I might be able to add value. And so, sometimes that involves being critical to them in private about acquisitions that maybe they have taken on. I can think of one company in particular right now where I'm pretty critical of a recent acquisition of theirs. I felt like they paid a little bit too much, and I had a pretty honest conversation with the CFO, and hopefully he's pretty responsive. And I think that they will avoid, I'm certainly hopeful that they avoid overpaying for businesses. Unfortunately, it was just a tuck-in deal, but at the same time, you don't want them to continue scaling up if they're going to continue to pay too much. And so to the extent that I can help from that perspective, I'm glad to voice my opinion. And I guess the other thing to think about is in terms of buybacks. So like I mentioned, in terms of capital allocation, a lot of these businesses, because they're inflecting on earnings, there's a cash accumulation happening on the balance sheet. And if the multiple is still very low, then I'll walk through my expectations with them for what I believe their share price can be 3 years, 5 years, 10 years into the future. And what I believe it can be if they take the excess cash and instead of deploying it into an acquisition that may or may not help them to consider buybacks. And I find that if I have built up trust with the management teams, that they're frequently, I won't say all the time, but they're frequently pretty responsive to that.
And the last one of the knots that I'll highlight is that you won't reflexively sell a stock that has risen dramatically. What are you trying to protect against by being willing to hold on to winners?
Yeah, this is really hard to do. This is one of the most difficult things, is to not sell something when it's gone up, it's exceeded your idea of what fair value is. And I think, to answer your question in terms of what I'm trying to protect against, I'm trying to protect myself against reflexively selling it at a valuation that I think is slightly above average. You know, if I buy it at less than intrinsic value and it's trading for, $1.20 when it's probably worth $1 today. But, I try to think more critically about how that dollar is going to compound over time. And certainly the multiples change over periods of time. And as long as it's not egregiously priced, as long as it's not a meme stock or it's trading at some ridiculous multiple of future earnings, it's as long as it's not, factoring in 5, 7, 10 years worth of growth and effectively being priced to perfection, I will try to continue to hold it. And that's a very, very difficult thing to do. I think a lot of portfolio managers who have had success will tell you something similar. My reason behind that is because it's really hard to find these world-class businesses. If you continue to raise the bar by finding new and attractive opportunities, then it just becomes that much harder to find really, really great businesses. And those businesses, when you find them, when the thesis plays out, they tend to over exceed expectations. They tend to continue to do well, and they deserve a little bit of credit for that. And sometimes they will, via their multiple being elevated. And as long as the long-term thesis is still in place, as long as they can continue to redeploy capital at high rates of return, then I want to continue to own that. Part of the attractive part about owning the equity markets is, if the reinvestment runway is still there, then your rate of return is very, very high. The ceiling is very, very high. And I want to align myself and give myself the opportunity for long-term compounding, and try my best not to interrupt that as much as possible.
This is probably a good time to talk about sell discipline. Why do you typically sell positions then?
Yeah, so always when the thesis is wrong. I will be wrong in this. I think the batting average for most managers is around 50%, and I'm probably in that same boat. I'm not going to try to tell you that I'm going to be right 100% of the time. And when I find out that I'm wrong via stress testing my theses, every day, every month, every quarter, I continue to stress test them. When I find out that I'm wrong, that's a pretty easy sell decision. While I try to hold on to my winners, I will sell them if they become egregiously priced, if there's too much just baked into them. And so there's a tension there of trying to continue to own my winners, yet also being willing to sell them if they become egregiously priced. Because at the end of the day, everything's based on sort of an asymmetric return profile. And if that asymmetry is gone, if the expected returns, if I can no longer justify them clearing that bar, then I will sell them. But by and large, it is due to me being wrong on something related to the investment thesis. And so if my hit rate is, or if my batting average is 50%, then I need to get out of my losers, not from a return perspective, my losers from a thesis perspective, as quickly as possible, and continue to allocate to the companies whose theses are playing out and should continue to play out in the future.
Given that you're underwriting what businesses are going to be worth 5, 7, 10 years from now, and you're expecting an inflection point at some point, my guess is that you have a hold period that's certainly longer than 60 or 90 days, but probably also longer than a year or two. So when you're initiating these positions, always with the optimism that you're going to be right, what is your desired hold period?
I'd like to own businesses forever, but that's not sometimes feasible. At my investment firm that I worked for, they were in the process of selling a company that they had owned for 18 years, and it had compounded at a very high rate of return for them over that 18-year time period. I'd love it if every single business was like that, if I could own it for 15 or 20 years or potentially longer. So I tell investors that I invest with decade-long holding periods. I don't invest in a business if I can't see it being worth significantly more in 10 years than it is today. If I don't see it still being around 10 years from now and in a much stronger competitive position. I don't want to own a business that's going to be that maybe has an advantage around it today, but that's going to be sort of competed away over time. I want businesses that their advantages, scale with the business. And so that's part of my checklist is basically looking at a business and determining, will it still be around 10 years from now? Will this service or will this good still be around 10 years from now? And that's hard to do, but I think that you can say yes for all of my holdings with a reasonably high degree of confidence in owning that. And so the idea is a 10-year plus holding period, although I underwrite everything on a 3, 5, and 10-year basis. And so I want to align myself with companies that I think have low probabilities of downside over a 3-year basis, low probabilities of downside over a 5-year basis, and high probabilities of upside over that same time period.
You have an excellent podcast of your own called Quality Investing. What made you start the podcast and what are you trying to accomplish with it?
Yeah. Thank you, by the way. I created this podcast because I view this asset management business as primarily sort of first and foremost being an exercise in trust with myself and my clients. And so the degree to which I can maximize the trust between me and my clients, I'm gonna take that. And so I'm experimenting with lots of different ways to build trust with my clients. And I created the podcast really just to share with my clients. And I started sharing it publicly because people started asking that I share it publicly. But I started sharing these interviews with the management teams of companies that I either own or that I've spent a lot of time researching and that I think are just doing something interesting in the world that I want people to be aware of. And so the idea behind it was there's a company called InPost, which I currently own. It's in the Asheville Capital portfolio. Everybody, please do your own due diligence before investing in it. But I wrote investment thesis for InPost. It's available online. You can check out Asheville Capital Management's website. And one of my clients got back to me and said that he just didn't have 2 hours to sit down and read the investment thesis, and that he trusts me. He trusts the decisions that I'm making, but he just didn't have the time in his day to sit down and read it, but that it sounded really interesting. And he'd love to learn more. And so my thought behind it was, well, I've had numerous conversations with the CEO and the CFO of this business. Why don't I just record one of these interviews and I'll put it out there? And that's an easier way for you to digest the content that I'm trying to put out there. And that way you can see that this is the investment thesis. Don't just take it from me. Let me talk to the CEO. Let me ask him the tough questions that I ask in regard to just underwriting these businesses, and we'll see what the CEO says. And sometimes it's not always the CEO. And in one case, I actually brought on a competitor of a company that I was invested in, and the competitor he gave me 2 hours of his time just talking about the company that his product that he created. He was the inventor of this competing solution. He talked about the product that he was competing against, and it's the HashiCorp episode. It's a company that I used to own. I don't own it anymore, but it was really interesting to hear the competitor talk about this business and the reasons why they're continuing to have success. And so I thought that was just really interesting information that's not widely available. Yeah, sure, you can go listen to earnings calls. You can listen to a couple of interviews, but I think in regard to my clients in particular, the reception was really positive. It's an easier way for them to digest and determine the way I'm thinking about these businesses, just by the questions that I'm asking the management teams. And so to back up and reiterate it, I viewed it as a trust building exercise with my clients, and I put it out there because I know a bunch of other people would find it interesting as well. But the goal is not to be the next Patrick O'Shaughnessy or something like that, and I don't publish episodes that often, 3 or 4 a year, really only when I find that there's a really interesting business model or a really interesting management team that I think my clients in particular should be aware of. It's been a pretty good success, although I'm not marketing it. I might tweet about it or something like that and say, hey, this episode was published, but I'm not marketing it. I'm not doing this every single week. My first and only job is to focus on being an exceptional portfolio manager on behalf of my clients. And to the extent that I can build trust with them over time, that should be a competitive advantage for me as an asset manager. And so I did this as an experiment in trying to improve and maximize that trust.
Listen to your excellent and insightful episode with the InPost CEO. We haven't really talked about specific ideas, so I thought it'd be fun for listeners to hear about that company and how you came across it.
Yeah, I came across it just because a friend recommended it to me. So that's how I come across a lot of ideas nowadays. Is somebody will just recommend it to me, and this person in particular, she recommended it to me because we had a common holding in an Australian company that I used to own that I don't own anymore, and I was just really amazed by the unit economics of this Australian business that I owned. And she said, if you really like the unit economics of that business, you should take a look at InPost. And so I just added it to my list. It's kind of like my my to read book list. The to read list just keeps piling up, and eventually I get to them. And I think 6 months later, I eventually got to looking at this company, and I was really intrigued. And so I guess that's how I came across it. But to talk specifically about InPost, it is a logistics parcel delivery company based in Europe. And so think DHL, UPS, FedEx. They deliver parcels, and their primary country of operations is in Poland, except they deliver parcels in a different way. So while UPS, for us Americans in particular, we're very accustomed to receiving packages on our doorstep, that's actually not how it operates in Poland in particular. So they popularize this out of home service called automated parcel machines. They abbreviate them as APMs, but effectively what they are is lockers that they put on street corners, they put in grocery stores, they put in parking lots, they put on sidewalks, in parks and things like that. And they're everywhere. If you ever get the chance to go visit Poland, you will see InPost lockers everywhere. There's 25,000 of them right now deployed in Poland. And I think it's 70% of the Polish population lives within a 5-minute walk of one of these lockers. And so frequently they're right outside of neighborhoods. They're they're in very public places that you tend to be walking by. And so InPost created these lockers because they saw that they could gain leverage over their primary fixed costs, basically. So if you think about if anybody's looked at e-commerce companies, you will know that the most expensive part of the package delivery is last mile. So it tends to be anywhere between 50 to 70% of the cost. So if it costs me $20 to deliver a package, $10, $12, $13 of that might be in last mile, basically. And so InPost, by putting these lockers in, they can deliver to the locker and have the customer basically do the last mile themselves at no incremental cost to a parcel delivery company. And when I speak of leverage on that fixed cost, now InPost couriers can deliver well over 1,000 parcels per day. In an 8-hour shift, they can deliver between 1,200 and 1,500 parcels per day. Whereas the door-to-door delivery person can only deliver maybe 80 to 100 parcels per day. And so you're talking about a 10 to 15x increase in efficiency per worker. And you also have decreased costs in terms of fuel costs and vehicle maintenance and things like that, because you're just driving to these locations, and you can fulfill overnight. People deliver when traffic levels are lower and things like that. And so the cost to serve dramatically got slashed. And so it's like 1/10, sometimes even 1/20th of the cost, yet it can be done more profitably. So I think it's really interesting. If you look at DHL's gross margins, it's like 18%, whereas InPost's EBITDA margins, they're 46% in Poland. And so you've got EBITDA margins that are more than double their primary competitors' gross profits. And so you've got this business model where you can dramatically slash the cost, but also do it dramatically more profitably. And that's a really attractive value proposition. It creates efficiencies that can then be passed on to the consumer and passed on to the merchants who are largely incurring these costs. And so the primary constituents that are bearing the burden of the cost, the merchant and the consumer, it's effectively slashed. It's down to zero, basically. The last mile is effectively down to zero. And so you have created effectively a win-win value proposition for your suppliers and for your consumers in a way that's also a win for you, in which you can do it more profitably. And so the value proposition is very, very strong. And over time, they've been able to build pretty significant competitive advantages via network effects. So there are some competitors, this will be the last thing I say on it. There's some competitors that have been trying to compete with InPost for a pretty long period of time, 18 to 24 months now, offering $0 delivery fees, and still haven't achieved significant volume. There are some that have been in place for 18 months that still only get 2 or 3 packages per day to a locker that's directly adjacent to an InPost locker that is fulfilling 250 or 300 parcels per day. And so it's incredibly difficult to compete with. And if you ask any Polish people, they will effectively say the same things. They'll see people at InPost lockers all day and nobody going to these adjacent competitors.
Well, I'll point our listeners to that episode where you can also learn about how the company is expanding outside of Poland into, other markets like France and I believe the UK. So it's working in other markets as well. So yeah, thanks for all that. It's such an interesting company and a model, and the margin profile was clearly pretty stunning and fantastic. So I get the how that fits within the world-class business framework. Before I let you go, I have a couple questions that I think anyone who's interested in learning more about your strategy or investing in with you would be curious to understand. And one of those is, there's a small team at Asheville. It's a lot of companies in your potential universe, without market caps constraints and without geographic constraints. So I'm just curious how you cover the vast number of companies in your universe today.
Yeah, I think there's no way I could honestly tell my investors that we own a basket of world-class businesses before they're broadly appreciated as such, if I haven't properly evaluated the opportunity set. If I can't say that these businesses are world-class relative to the rest of the investable universe, then I'm not being honest. And so what that involves, in order for me to honestly say that, is looking at a lot of companies. And in order to look at a lot of companies, you really have to have a love and a passion for doing this type of work. I think the passion is sort of what feeds me. I know that this is the field that I was meant to be in, because I love it. It's what wakes me up in the morning, is to go look at lots of businesses. And so I'll look at several hundred companies a year, trying to find the companies that have, really attractive value propositions, really durable competitive advantages, that are mispriced, that have the ability to grow shareholder returns at high rates for extended periods of time. And so that just means that I turn over a lot of rocks. And you have to turn over a lot of rocks in order to actually say this, in order to feel a reasonable degree of confidence that you actually own world-class businesses. And so I would just point back to that is there has to be a love for doing this in order to own these types of businesses, and in order to be honest with your clients, I guess.
I would like to leave a conversation with a manager without discussing a mistake. What is an investment mistake that has forever changed the way you invest?
I think the one I'd like to point to is, I read this really great book a few years ago called The Art of Execution by Lee Freeman Shore. And I found in that book that I was making several mistakes. It sort of held a mirror up to me, and looking at my own portfolio decisions that I was making. And I think the one in particular that I'd like to highlight is he points out, what you do in the face of drawdowns really defines what your future returns will be. What it really defines who you are as an investor. And he has different categories for types of investors and things like that. And I found myself making the mistake of in suffering a drawdown, it's very easy to just chalk it up to volatility. And that's true. In a volatile market, especially in international companies, they will be choppy, but sitting on my hands is not a viable option. And I found myself sitting on my hands a lot. And he does a really good job of quantifying things, of what happens if there's a 25% drawdown. And we all know these things intuitively. We can all do the math on it. But his experience in seeing managers who outperformed was, they have pretty strict rules around this. Is what when you suffer a drawdown in a company, what you do really matters, and you're really only faced with two decisions. And one is exit the position entirely, and two is to add more to the position. And I found myself sort of not making a decision, or at least not forcing it soon enough. That's a mistake that I made multiple times that I've tried very significantly to improve. And so whenever I have, for me, it's a 25% drawdown. For other people, it can be, a 20% drawdown or a 30% drawdown or whatever. I force a complete re-underwriting of the companies. And so I'm always doing small re-underwritings, but when I have large drawdowns, I force a decision to be made and a complete re-underwriting of everything. That means taking my models, taking everything and sort of throwing them out the window and trying to go back to everything, thinking of it from a first principles perspective, and to rebuild the thesis and to determine if I come to the same conclusions. And so I think doing that forces me to sort of play devil's advocate against myself in ways that I didn't maybe previously do quite to the extent that I'm doing today. And ultimately, if I come to the same conclusion, on these businesses, then I'll add more. And if I can poke a sizable enough hole in my thesis, then I will exit it.
Yeah, I mean, it's a really insightful thought, and also the kind of evolution of your strategy. Thanks for sharing that. We'll close with the question we ask all of our manager guests, which is, what is the most underappreciated aspect of the investment opportunity in front of Asheville Capital Management today?
I'd love to have a really brilliant quote for you here on this, but I'm afraid it's going to be somewhat basic. I think the most underappreciated thing, the most underappreciated thing is just the compounding power of owning these businesses that are truly world-class, in investing in these pockets of inefficiencies, investing in businesses that are severely misunderstood. And that's very clear via the price implied expectations of their businesses today. Investing in companies with long-term durable tailwinds, they have competitive advantages that ensure that they should be the market share leader and the incremental winner of market share capital efficiently over multi-year periods. I think just the compounding power of that is just something that's very easy to overlook. If I think about any sort of edge that I have relative to my peers, it's just having a longer term mindset and being willing to be along for the ride despite volatility, and actually taking advantage of volatility and seeing it as the opportunity that it truly is. And then just in trusting in the management team that I've spent a very significant amount of time underwriting, and the value proposition and the competitive advantage and the industry that it operates in, continuing to have confidence in the compounding power of the current earnings and the reinvestment of those earnings at high rates of return.
Well, given it's a podcast called Compounders, maybe a simple answer, but I also think it's the perfect answer and the perfect way to close this
I appreciate
this discussion. So, Jake, thanks so much for sharing your journey and the evolution of your strategy, and double clicking on so many aspects of it. We're going to be excited to see where this all leads you, and so we appreciate you being on the show.
Thanks, Ben. Thanks for having me.